Okay, guys, this is our first time using remote teaching, so I'm not sure, how do you think about this way? So let me know what's your feedback, right? So I will collect your, suggestions, right, on the blackboard, right? So you're welcome. Give me any feedback, right, about this online teaching, right? So we will hold some pre-record, videos on the YouTube and my website for to learn right from many lectures. And then we also holding some live sections, right? I mean, for these matters with a team project using Excel. So for that, budget capital budgeting project, right? We will given, live sections. So I will post the details, right? And also send you announcement about when and how we will use our, live sections, use Blackboard, collaborate, right? In a few weeks later. For now, we will, pre-record these videos, right? So I will give the details for the lectures, and if you see any questions, right, you meet, right, in these videos, right, please let me know, right? Okay, so first, I'm going to review our questions in our first midterm. I post your grade on Blackboard, right? So you can see your grade on, on the grading centers, and also the answer to every questions for this test are available in the lecture notes folder, right? You can basically see every instructions of each questions, right, on the blackboard. And we only have one problem solving, right, in this test. And so that's why I try to, today go over these questions, right, with more details, right? The other questions are multiple choice, right? I put all the solutions with instructions on Blackboard, right? But for these questions, because we have taken case studies in class, right, for this car finance, right, very similar, right? So that's why I try to go over this question at first, right? So in these questions, we must to solve the monthly payment, right, for a car finance. The car's price is $45,000, and you trade in your old car for the down payment, right? $10,000. So how much left you need to pay will be the difference, right? But you are also given a what? Direct rebate for what? $2,000, right? So what you actually need to pay for the car finance will be the 45,000, right? Minus 10,000. And minus what? 2,000, right? So 45 minus 10, 35. And 35 minus 2 will be what? $33,000. That will be how much you need to pay for this car, right? That's also the amount you will do what? Do the car finance, right? So that's the PV. So why this one is the PV, not future value? Because you bought this car now, right? You need to pay this money, right? With the monthly payment, right, to pay all this balance on your finance account, like our credit card charge, right? So this one is the PV, right? You pay this money now, right? You got this money now, you bought this money now to buy this car, not in the future, right? So it's a present value, right? And what's the finance package, right? You got a 5-year contract with the annual rate, what, 6%. Be careful. Our questions is to solve what? Monthly payment, right? Like our credit card questions in class, right? We need to pay the balance back every month, right? Not every year, right? So both 5-year and annual rate should be do some adjustment. 5 years equal to how many months? 5 times 12 equal to what? 60 months, right? So that's how many what period. And This is annual rate, right? What's the monthly rate? Will be 6% annual rate. Divided by 12, we got monthly rate, right? Equal to 0.5. That's the IY interest rate, right? And if you don't clear the storage of the financial calculators, right? You must to set your future value into zero, right? Zero means you pay all the balance of your account for the car finance. There should be nothing left on your debt, right? There will be no penny left for this car finance, right? And then you need to solve what? Solve the monthly payment, right? So that's a step to solve the first questions, right? If you follow this step, you should solve the payment as what? $637.98 around to what? $638, right? That's for the first questions, right? You will pay $638 for the car finance, right? For this car finance every month. For second questions, be careful. If you will take 0% APR, right? 0% APR means no interest. However, you will not given the rebate anymore. There will be no rebate, right? So no rebate means this one will be not off of the balance, right? And the very beginning, right? So what you need to pay will be not this amount anymore. Will be 45,000 minus what? 10,000, right? Equal to what? Equal to $35,000. That's your PV, right? With no rebate. And you have no interest. So 0 SIY, right? Still 5-year package, so 30 months, right? And 0 future values. You come to solve what? Payment, right? You can use this one to solve what? Solve the monthly payment for second questions. Or you can solve it even more easily. By how much? You can say there's no interest, right? And you need to pay this one back forward for 30 months, right? So why not just easily divide by what? 35,000, right? By what? By total 30 months, right? You split this balance into 30 payments, right? So what's the monthly payment, right? You can divide this amount by 30 months directly without taking these steps, right? Both ways can solve the monthly payment for the second questions, right? The answer should be what? Should be $583.31, right? So this amount is much less than the payment in the first questions, right? So the second options, right? This offers is better, right? You can save the money for every month, right? What's the difference? You can check, right? 638 minus 583, right? 8 minus 3 will be 5, right? 63 minus 58 will be 5, right? $55 saving, right? Every month if you take the second option, right? So for a total 30 months, right? It will give you what? It will give you total $3,300, right? That's your total saving if you take the second options compared with the first one, right? You can say if you offer with 0% interest, right? Even with no rebate, you will receive this amount, right? So if you are very good investors, right, you know what we learned from the time value of money, you can make smart decisions, right, to take the second option, right? So that's why we study this course, right? So I hope you can, get some idea, right, from these questions in this test. Okay, so for today's class, right, we will not take time to review every questions in the first test. We will continue, to study the questions and topics, right, in chapter 7 about what? About bond and interest rate, right? In the last class, we just start to, track the bond, right, with some pictures, with the website of the Bloomberg, right, terminals, right? We saw the bond market, and we see that many countries issue bond, right? Not just the corporations, right? Government also issue bond, right? So let's take a look, right? As the picture we saw in the last class, right? And you can see this one we mentioned, right? Is what? Is face value, right? It's face value, right? And this is what? This one we call coupon rate, right? So we know the face value, right, is something you will get paid at maturity, right? And your annual interest you will get paid if you hold this bond will be face value times what? Times the coupon rate, right, equal to what? 500 times 3% equal to what? Equal to $15, right? That's how much interest you will receive, right, if you purchase this bond, right? And why we call this one as coupon rate, you can see here, right? You see there are many coupons attached below our bond contract, right? Like our regular coupon you can see in a grocery store, right? You can take this coupon off once you receive each payment of interest every year, right? And that's for the convenience, right? In the old time, right? People now use electronic trading platform, right? So they will keep these papers, right? Once interest get paid, they will take this one off, take a record, right? So that means they already paid interest, right? After all the interest paid, right? After all the coupon take off, right? Then on maturities, the investors also got its face value back on the maturity. So government pay you the interest every year and also pay you the face value on maturity. And that's how the bond works, right, for investors. Be careful, for most bond in the US market, right, the interest paid what? Semi-annually, right? So means our annual interest will be split, right, into the two payments each year, right? Half, right? So 15 divided by 2 will be what? $7.5, right? So you can see that's why the numbers in the coupon, right? In the coupon is $7.5 each, right? Every 6 months you got what? $6.5, right? That's the picture we saw in last class, right? Let's review what is bond again, right, in this video.
You probably know investors use bonds to add income and diversification to their portfolios. But what exactly are they? A bond is a security that represents an agreement to repay borrowed money. Bonds typically have the following characteristics. An issuer. This is the entity that has borrowed the money. Issuers include the United States government, states and municipalities, and corporations. Principal. This is the amount of money borrowed by the issuer. Because issuers may borrow hundreds of millions of dollars at a time, the principal is divided into units, each called a bond. Bonds are typically issued in units of $1,000 each. Maturity date. This is the date when the issuer must repay the principal to the bondholder. Maturities usually range from several months to as many as 30 years. Interest rate or coupon rate. As with any loan, the issuer pays interest on the borrowed money. The rate of interest paid by the issuer is usually determined at the time the bonds are issued. The rate of interest you'll earn depends on the price you pay for the bond when you buy it. Let's look at an example. If a company issues a $1,000 bond with an interest payment of 5%, the company will pay the bondholder $50 per year. At maturity, you would be paid the entire $1,000. When choosing a bond, credit ratings are an important consideration. Businesses with lower credit ratings are generally considered riskier and must pay more interest to attract buyers. Therefore, lower-rated bonds pay higher interest rates. Buying a variety of bonds across interest rates and risk profiles can help keep your bond portfolio diversified. Bonds are generally considered a safer investment than stock of the same issuer. Just a small allocation to fixed income can help you diversify and significantly reduce volatility in your portfolio. Also, keep tax implications in mind. Many government-issued bonds pay interest-free from federal or state income taxes. To get started with bonds, visit our Comprehensive Bond Resource Center. Use our Bond Selector tool to quickly find the right bonds for you. Or call our fixed income specialist if you need a.
Okay, so I think from this video you can see what is bond very clearly, right? And also you can study, why we need to buy bond, right? So because last class, right, one student asked me, right, because we saw the yield of the treasury bond on the Bloomberg, right, terminals, right, is very low. So why we borrow to buy the bond, right? The yield is such low, can even less than, the inflation rate, because the bond can diversify your portfolios, right, to reduce your risk. And also bond will be tax-free, right? That's very good, right? So you see our stock, right, paid a high tax for capital gains, right? But bond is not, right? So that's why we buy the bond. And you can see, even from the chapter 2, right, we study the income statements. You can still see how the bond works, right, in the income statements, right? In the income statements, right, we start from what? From net sales, right? Net sales, right? Minus what? Minus cost of goods sold, right? Equal to what? Equal to the gross profit, right? Gross profit minus what? Minus operating, expense, right? Operating expense equal to what? Equal to the operating profit, right? Or you can call this one as what? EBIT, right? By the way, what is operating expense, right? We mentioned in class, right? For example, S, G, and what? A, right? Selling, general, and what? General and administrations, right? And also research and what? Development, right? Development cost, right? R&D. EBIT is what? EBIT is earnings before the interest and tax, right? So which one, right, in these orders should be paid first? Should be the interest paid first, right? Interest is before tax, right? Then we need to minus the tax, right? We have the what? Net income, right? So let's see the sequence, right? You see, after you generate, right, operating profit, right, who you will pay first is not someone else but what? But the long-term debt what? Holder, right? So that's what? That's the bond holders, right? Bond holders, right? But bond holders are the first group will be paid, right, from the operating income, right? After you pay these debt holders, right, then you need to pay what? Pay the government and pay the tax. If you still have something left, right, we call residual income, right? You need to pay what? You need to pay the preferred stock, right? Preferred stock, right? Preferred stockholders, right? That income will pay the preferred stockholders as what? As dividends, right? Then remaining residual earning will go to what? Will go to the common stockholder, right? Common stockholder or common equity holders, right? So if you purchase stock, right, in the stock market, you can say you are not first get paid. Actually, you are what? You are last one to get paid, right? Very unlikely, because if the company go to bankruptcy, right? If they don't have enough money, right, only that holder will get paid first, right? Not the others, right? Not the others, right? So that's why the bond, right, is more conservative, right? It's a safer, right, investment, right? Safer investment, right? Even returns low, right? But our bondholder, right, also has the priority to get what get paid, right? And then their yield is relatively less risky, right, than our stockholders, right? You cannot expecting to see the return of a bond, right, will be very high, but it's also safer, right, than our stockholders, right? To study the bond, right, we mentioned in the last class, right, we want to figure out, right, first one, what is the face value for this bond, right? That's the price you can see directly from the bond contract, right? You can see the face value for this bond is what? $500, right? It's totally, just the number you can see directly on the page of what? The contract, right? That's the face value, right? But in these matters, right, we're assuming all the bond with the face value what? $1,000. No exception, right? No exception. This one, right, is consistent with our assumption in the CFA test, right? In the CFA test, we're assuming all the bond with the face value what? $1,000, right? No exception. So if you say in the future questions, there's no face value given, right? We're assuming all the face value is what? $1,000, no exception, right? The next you must pay attention in the contract is how long of this bond will be effective on the market, right? That's the durations, right? Durations, right? That's how long the market, right, will have this bond still, effective, right? So it will last for long term, right? For long term, for most bond, right? Usually 10 to 20 years, right? If you still remember, right, in the last class we showed the bond market, right, on the Bloomberg website, right? You can see our treasury issue different, duration of the bond, right? Some bonds are issued with the short term, right, only for a few months, right? 6 months and 3 months, right? And this bond we call what? This treasury issued debt, right? We call our what? T-bills, right? It's only with the durations, right? Less than a year, right? Less than a year, right? We just for few months, and that's for T-bills. And if the treasury issue debt, right, will last for a few years, right, for intermediate terms, right, this bond we call what? T-notes, right? T-notes, T-notes, right? T-notes usually has the years between the 3 years or 5 years, right? The last one we say the bond can issue even more than what? More than 10 years, right? T-bonds. So T-bonds are issued in what? 10 or 20 years, right? So you see the name is classified, right, according to how long of the bond on the market, right? If the bond within a year is called T-bills, right? So this is on the what? On the money market, right? On the money market. But for these two, right, it's not like this one within 12 months, right? It's more than a year, more than 12 months. So these are issued on what? On the capital market, right? Capital market. So we need to determine, right, how long of this bond will be effective on the market, right? Last one is the coupon interest rate, right? You can see the coupon interest rate is also given, right, on the bond contract, right? For example, in these questions, on these pictures, you see what? 3%, and that's your annual interest rate, right? It's not annual interest amount, right? But our annual interest rate, right? So if you want to, to determine what's the interest you will receive every year, that's the amount, right? Should be the face value times what? Times by this interest rate, right? Times by this interest rate, right? For example, if we are given 5% coupon rate, right? That means your interest will be what? 1,000 times 5% equal to what? $50 each, right? $50 each as interest payment, right? So that's the three items you must to pay attention when you try to read a bond what contract, right? Based on these three items, you can figure out, right, what's the price you're willing to buy this bond, right? Buy this bond, right? Let me show some questions we left from last class, right? Last class we already, give a brief introduction to different bonds, right? So I will now repeat again. Right? So for example, right, zero coupon bond, right, means the bond will not pay any interest, right? There's no interest any year, right? And then convertible bond means the bond can be converted to the what? To a common stock, right? After maturities, right? And we also show the bond with call provisions and bond with put provisions last time, right? The call means what? Call means the buy, right? Put means sell. So for the bond with call provisions, right? Who will buy the bond back? The company, right? Or government, they will buy the bond back. So that means the issuer, right? Issuer can buy the bond back if they found market interest rate are less than what? Less than interest rate of the bond, right? So why not, buy this bond back? And they can, save the interest by replace with a low interest bond, right? That's called a call provision bond, right? For put provision means you want to sell it, right? Sell means put. Who will sell it? Of course, the bond holders, right? That's investors, right? So investor can sell the bond, back to what? To a company. Why not? Why not? Why they want to sell the bond back? Because sometimes market interest rate are even higher than the bond interest rate, right? So, it's better for them to get the money back, right? To directly put into the market, right? The savings has less risk than the bond, right? So why not put the money back, right, to the saving account, right, with a higher interest even, right, than the bond interest, right? So that's for the bond with provisions. We showed in the last class, right, if something good to you, right, something will be what? More expensive, right? So the bond with put provisions is usually trading with a premium, right? Similarly, right, for the bond with call provisions, it's good for what? For issuer, but not good for the investors, right? So this one will trading with a discount, right? Discount. Only, offer a discount that people willing to buy, right? It's not good for them, right? So they need to, get a discount to buy it. And for the TIPS, right, we showed on a, Bloomberg, right, web page last time, right? TIPS means the treasury what? Inflation protected securities, right? So we show the TIPS, right? The face values, and face value is not fixed, right? But face value will change with what? Changing with the CPI, right? Consumer Pricing Index. So when the inflation is high, our face value is also high, right? So your inflation costs will be protected with what? With more what? More interest, right? The face value times the coupon rate is interest amount you can receive every year, right? With a given coupon rate, when the face value goes up with the CPI, you are given what? You are given a higher interest to compensate your what? Your inflation cost, right? So that's why this one named as what? Treasury issued right? Inflation protected what? Security, right? Today our job is to what? To pricing a bond, to value a bond, right? So we always, keep this principle in mind. Right? What's our principle to do the valuations? Is to bring all expected future values, right? Future cash flows, right? Cash flows into what? Into present values, right? We show many of these examples before, right? For loans, right? For rent, for student loans, right? We show all this stuff before, right? Now we will apply the same, methodology to pricing what? To pricing the bond, right? Let me show the examples, right? Our examples, right, is offered with this contract. It's a 5-year bond, right? 14 as discount rate, 6% coupon rate, and 1,000 face values, right? So you see, we have the 5-year bond, so means you can receive interest every year for how many years? 5 years, right? And also on maturity, right? At the end of 5th year, right? 5th year, you receive your face value back, right? So what's the cash flow looks like should be in this way, right? There are 1, 2, 3, 4, 5 years, right? And every year, right, you will got interest what? 1,000 times 6% equal to $60, right? So you receive $60 on each year, right? And also, like we mentioned, on maturity, you got face value back. So on time 5, another cash flows, right? $1,000, right? That's how you will receive the cash flows if you purchase a bond onward on time 0, right? And because you put money, right, into this long-term debt, right, for the issuers, right, you were asking for somewhat, for some return, right? So what's your request return? Is this one called yield to maturity discount rate, right? Yield to maturity, right? What that means? Means if you're holding a bond, right, from time 0 to maturity, right? What's your annual compounded yield? What's your annual compounded request return? Right, it's 14%. So that's the compounded what? Discounting rate, right? So basically you can see our cash flows were in, this format, right? One is your annual interest payment, right? That's an equal amount, right, every year, and be more accurate at the end of the year, right? So these ones are what? Ordinary annuity, right? Right? And this one's only a single cash flows, right? Only one-time payments, right? So this one's called what? Lump sum payment, right? Lump sum payment. So basically, you have two cash flows. One's ordinary annuity, right? One's lump sum payment, right? You will solve the price of the bond by solving the present value of these two cash flows. Use our discount rate, 14%. Right? So you will discount these two cash flows to a time 0, right? To solve what? To solve the present value. Right? The formulas will be in this format, right? But it's not easy to handle, right? So like we mentioned on the chapter time value of money, we always use what? Our financial calculators, right? To solve the PV, right? Use the financial keys, right? So like we mentioned, right? If you saw ordinary annuities, right? It is a what? It is a payment, right? This is a single lump sum payment, so it's a future values, right? And this is our discount rate is what? I1 interest rate, right? And you solve what? You solve the price and values, right? Now let's plug these numbers into our financial keys, right? 60 as what? Payment, right? 14 as what? IY, right? There will be no percentage, right? Because our financial keys, right, it already has a percentage embedded in the key, right? So just 14 as IY, right? 5 years, 5 as what? And, right? And future values is what? $1,000, right? Like we mentioned, we're assuming all the what? All the bond in these matters, right? With the future values $1,000, right? $1,000, right? This one. Then after you finish this input, you will press what? CPT, right? CPT. Solve what? Solve the present value. Press CPT, then press the PV. And then you can see the answer will be shown on your screen, right? $725.35, right? Please confirm this one with your financial calculators, right? To see can you got this answer or not, right? And you can see the number is what? It's minus, it's negative, right? Negative. So please pay attention to this one because you see the signs is opposite to what? The sign for the payment and what? Which values, right? So we call this as what? As the sign conventions, right? Sign conventions, right? These two must have what? Different signs, right? So let me explain this one for a while, right? So you can figure out what's the meaning, right? Because some students made mistake, right? In the first test, right? They don't put the sign between the what PV and future values in the test, right? So they got a what error mistake, right? Error output when you use the financial calculators, right? Let me explain why these signs are different, right? Use the direction of what cash flows, right? You see, if you want to buy the bond, right, you will pay this amount of money. So this one's out of your pocket, right? You pay this money to a company, right? You purchase this bond, so this out of your pocket cost, right? It's outflows, right? So it's negative, right? Once you purchase the bond, right, you can receive what? You can receive the money back, right, in a two kind of cash flows. One's annuity, right? One's future face value payment on the maturity, right? So both are into your pocket. Is what? Inflows, right? So basically, right, these signs just means the direction of cash flows, right? It's in a perspective of what? Investors, right? Investors, right? If in the perspective of a company, right, the sign will be opposite, right? If you put negative sign for both here, right, then this one will be positive. That's in the perspective of company or issuers, right? From investors' perspective, right, will be these signs, right? This is how much you paid to buy this bond, and this is how much you will receive in the future, right? So there will be one is outflow, one is inflows, right? So you can follow these instructions, right, to solve the values. Okay, so that's the questions we have, right, in the last class. Okay, then we will explain something, right, very useful as what? As some secret rules, right? Use these rules, you can determine the price. Sometimes even not solve it, right? It's very useful, right? Let's see how this one works. First, you can see in our questions there are two percentage. One is what? Yield to maturity, right? One is what? Coupon interest rate. They are both what? They are both percentage, right? So what that means? Right? Why we need to put focus on these two? Right? Let me show something here. Right? Yield to maturities, right? Like I mentioned, right? It's the your required yield, right? If you're holding the bond to maturity and to maturity. So this one is your what? This one is your opportunity cost. Right? If you don't put the money into this long-term debt, right? You can put money in somewhere else, right, to get this what return, right? So that's your opportunity cost annually, right? And then what's your coupon rate? Coupon rate is your what? Annual interest rate. Annual interest you got every year, right? So this one is your what? It's your compensation, right? It's your reward, right? So this one is your cost, and this one is your what? Benefit, right? So we can do some comparison, right? To see which one is bigger, right? To determine what? The price, right? For example, right? If the yield to maturity just equal or happen to equal to what? Coupon rate, what should be the price of the bond be? You can see here, right? If the cost equal to what? Benefit. Alright, if the cost equal to benefit, right? Then you should be what? No gain, no loss. Right? So what you want to pay just equal to the what? Face value, right? Equal to what? $1,000. Right? So the price of the bond should equal to what? $1,000, right? If the yield to maturity equal to a coupon rate, right? Then if the yield to maturity what? More than the coupon rate, okay, that means that what? Cost more than what? Benefits, right? If you buy something, right, what you cost more than what you will receive, right? You of course will be what? Not happy, right? You might to what? Take offer on what? Discount, right? If you not offer discount, why you need to buy something? It will give you what? More costs than benefits, right? So in these situations, right, bond will trading with what? Discount, right? So the price should be less than what? $1,000, right? Then we have the third case, third situations, right? Right? That's what? That's yield to maturity, right? Less than what? Coupon rate, right? In such case, right? The cost, right? Less than what? The benefit. Okay, so what you sacrificed, right? Is less than what you will receive, right? So most customers were happy about it, right? So they will auto buy this one, right? So push the price even higher. That means what? That means the price will trading with what? With a premium, right? So that means the price will be what? Will be more than what? $1,000, right? So these three rules can help us, right, to determine the price without doing any calculations, just by compare what? By comparing yield to maturity with what? Coupon rate. Right? If you look at these two percentage, right, see which one is bigger, you can determine the price in these three different what? Scenarios. Right? So I hope these rules, right, can make you do a rough estimations, right, when you do the calculations, right? So you don't need to do the calculations, right? By comparing these two percentage directly, you can, check the price, right? It should be more than 1,000, equal to 1,000, or less than 1,000 directly, right? That's our three rules.